All right, traders, my name is Blake Morrow with Forex Analytix, and with me today is the one and only Chris Weston, head of research over at Pepperstone Securities. What's happening, Chris?
G'day, Blake. Good, Blake. I'm just laughing because we're trying to keep this to 15 minutes, and we both talk like we can't be stopped. So let's keep it succinct. Let's give people some good information and try not to do it in 5 hours. So yeah, it's good. It's good to be here, mate. It's good, great to be in speaking to your clients and subscribers.
It's nice to have you here, Chris. And I'll tell you, it's funny because we're on the opposite sides of the earth right now, and you're starting your day, so you probably have a lot to say. And I'm at the end of my day, so I start rambling, and so we might have a problem, but we're going to try to avoid that.
Mate, it's also Friday here at the moment. We're recording this on Friday, so yeah, this is the time when we're sort of thinking about going out for lunch with clients and catching up and sinking into a good steak. So yeah, let's talk shop. Let's talk markets.
Let's do it. So we're a little more than 24 hours past the FOMC meeting, and Powell didn't surprise anybody. He went along with his playbook. Every bank was expecting a dovish, Chairman Powell, and we got it. Dollar weekend, stocks, were S&P is at new highs again today. Most equity markets are responding well. How do you see things following the FOMC meeting now?
Well, mate, I just want to sort of take a step back because I think when as a strategist, stroke trader, we're always looking at our playbooks around these big event risks. And this was as dovish as he could have been. I mean, I think positioning in markets, whether you're looking in the treasury market, dollar had become a much more cleaner structure. But what we had anticipated, we thought there was a probably above 50% chance that he was going to change. He was going to remove the sometime. That one word from the, it's going to take some time before substantial progress is met. He didn't, and that's where we got the dovish report. So it was about as transitory, was peppered throughout the statements. Positive news was offset by nuance. It's still a lot of work that he needs to do on in the labour market. We'll talk about the labour market because it is really all about the labour market now in the US, and rightfully so. But I think the fact that there's still some time before substantial progress is why it was somewhat more dovish. We saw a little bit of buying in treasuries, not much. The dollar sort of weakened against high beta currencies, and now we're at a situation where we just know the Fed are in no rush at all. They want to let the economy run ultra red hot. That has its risks, but we've now got our checklists as we go into really the August period between now and August to understand what constitutes a substantial progress. And then we're going to get that announcement of tapering. There'll be a period of time after they've got down to, to completed their QE program down to zero. There'll be a period of time before they potentially look to raise rates at some stage. So there's a chain of events that we have. But I think in the next couple of months, we need to look at the data to understand if that constitutes substantial progress, and then we'll get a tapering of asset purchases.
So when you're talking about data, and that brings up even next week, next Friday, we have our US jobs report. And so what that probably equates to in my mind is, the weaker the data, the better it is going to be for asset prices, marginally, obviously not as long as it's not a huge miss. But if it's a big beat and the market's actually looking for a big beat, did the rumblings really start everybody starts talking, well, maybe, we get that taper talk sooner rather than later.
Yeah, I think the Fed have done a brilliant job in communicating their resolve to, overlooking what market pricing has done and that they're pushing back as long as possible. They would really want to see the meats of inflation's eyes and that the unemployment rate. We're not talking the U3, the classic unemployment rate, but we're talking about the broader measure, the U6 rate, which takes into a lot of people, a far more broad situation, which stands above 10% at the moment. They want to see that closer towards 6%, perhaps even lower down towards full employment. But yeah, you're right. I mean, we're in a place now where next week the payrolls number is, the consensus is 950,000. So that would be two really, really, really strong numbers. Is that substantial progress? Probably not. I actually believe that number is probably going to be well in excess of 1 million. And how will markets react if we do that? Look, it's somewhat on its way to substantial progress. So, obviously you're going to be looking for a sell-off in the treasury market. 5-year treasuries would sell off a few basis points depending on the number. your natural reaction, if you want to play that for a stronger number, would be dollar Swiss or dollar yen would be probably your closest one there. I'd probably favour dollar yen is going to have that closest tick to the Treasury market. A strong number would probably see if Treasury yields are going to go higher, we see a sell-off in the fixed income market. Equities may struggle. I know it's great for economics, but you're probably going to see the Nasdaq underperform against some of the large cap value space. So I think you'd see value working well. Financials would be a great place to be. Energy stocks would probably do quite well, but then your high tech, your sort of your bond, quasi bond stocks, your duration assets were probably under pressure. But if you're looking for a really strong number, which I suspect is the case, then you'd be looking at your bond proxies in FX, which would be just your dollar yen, your dollar Swiss. And then probably emerging market currencies will underperform there. So, I think it's an interesting one. A really weak number, and you're going to see some of those rate hike expectations being priced out of the market. Great for liquidity proxies. So your Aussie dollar is going to do well. Your Kiwi dollar, your CAD's probably going to continue in its merry descent lower against or higher against the dollar. So that would be the playbook there. Where it's going to go, I suppose the risk is that we're going to see a much higher than expected number. So I'd probably be looking for a higher dollar yen. But of course, as we know, Blake, trading around announcements is a tough one. It's not something I generally promote to clients, to be honest. If anything, I tend to tell people to cut back on those positions over those big news. But that's for each for their own strategy.
Sure, and and it's interesting when you think about just a few things that you said that I think are standout for traders to really hear. Is you're like, well, maybe some of the energy stocks are going to outperform, and the Nasdaq stocks are going to continue to underperform, and that's been a real common theme with the markets, especially when you're talking about equities. Is this continued rotation from into more conservative growth type of stocks and less and more out of and out of beta, but the important thing that I think most people need to understand is when you see a rotation like that. That's not bad for equities overall, and it's not bad for risk. And I think a lot of people translate, wow, great number. You start to see the Dow move higher, Nasdaq stocks move lower, and you cue into the Nasdaq stocks moving lower, but you're not focusing on the fact that it's really the broad markets are still moving higher overall. Unless you're seeing a broad-based sell-off, I think you have to be really careful how you trade it, especially in currencies or other assets.
I question what's going to cause that rising tide to lift all ships. What I mean by that is that we just see a classic risk off scenario. At the moment, you're right. At the moment, it's just like, let's get out of, tech's not doing too badly, actually. We've seen some fantastic earnings coming out of some companies like Apple and Facebook. But what's going to cause just a general risk-off sentiment? I look at this checklist of things. So we've got the payrolls next Friday. You go I think 4th of June we get the next payrolls number. There's going to be a lot of pressure on that because 3 really hot numbers constitute substantial progress. So we think that one on early June is going to be another number above 1 million, and then on the 10th of June you've got the next CPI print, which last month was 2.6%. You're probably going to see that once again above 2%. So you've got that checklist as we go through there. I don't think the June FOMC meeting will be the platform for the Fed to announce tapering, or it will just be a platform for them to sort of lay the foundations for the Jackson Hole Symposium in late August. Everyone should have that on their radar. It's going to be one of those events where just the media talks about it time and time again. We're all going to be completely sick and tired of talking about Jackson Hole Symposium by July time. It's just going to be one of those things where, Bernanke in 2013 used it as a platform. Jerome Powell's used it as a platform as well. So, the Jackson Hole Symposium, not just one of the most beautiful places on earth, it does have pedigree for major announcements, and that's where we'll be. So I think in that window going into Jackson Hole, the market has to deal with the idea that you've got the Bank of Canada cutting back on its QE program. That's fine. You've got the RBNZ doing the same, they're tapering. You've got the Riksbank in Sweden also doing so. But the daddy in the room is always the Fed, right? They are the world's price maker. And, if the world's saying, even though they've given us loads and loads of tailwinds to understand and digest this and price this in, I think the idea that the Fed are going to be cutting back on its QE program is symbolic in itself. And then you add in the fact that the capital in the general account, the Treasury general account that's been withdrawn. So the Treasury have been drawing down funds from the TGA, which have been held with the Federal Reserve, and that's been seen as a liquidity injection into markets. It's been really good for boosting assets. That will end in late July, and they'll start rebuilding it. Some of those funds will be given back to the Fed. That will be taken out of the market. So that's going to be considered a net liquidity withdrawal. If you mix in this idea of tapering from multiple central banks, the ECB, we can chuck the ECB in the mix as well, plus the rebuild of the Treasury general account. In the world that lives on liquidity, feasts on liquidity, can we survive these very, very frothy markets with those double sides coming through? And I don't think that. So I think there's a possibility in that scenario that we do see at some stage, well before in that, because markets are obviously forward looking, that we get a risk off scenario. People will be degrossing, people will be hedging, will be much more prevalent for the aggressive traders out there shorting opportunities. And I think that's where we do see a classic risk off scenario. What causes that? Well, the thing for me, the thing that I'm looking at from a macro perspective is twofold. One, inflation expectations. We look at break evens. If inflation expectations continue to trade on their merry ascent higher, and then we start seeing the interest rate markets pricing in a higher degree of hikes, that would be a toxic mix, and that's what I'm going to be looking for. So, for me, I might go. For rates, we might go to like TradingView, for example, and you can look at rate differentials in euro dollar futures, which let's say between December 2023 and the current contract, and you can see what's being priced in terms of interest rates. That's a tradable rates market. So the combination of higher inflation expectations and then a much higher degree of rate hikes, which are already pretty high at the moment. I don't think any risk assets are going to like that. The dollar will like that. But and the Japanese yen will like that, and probably maybe the euro against certain currencies because it's a funding currency. But that would be for me the toxic mix, which will cause a lot of this froth to come out of market all at one time, and we'll just talk ourselves into this kind of risk-off thematic. So I think we're getting to a period now where we're going to see higher volatility, and I think it's going to be driven by this mix of less liquidity in the market. So that's something that we need to look out for.
So hopefully, hopefully we still have some time left for assets to continue to rise, the broad markets to continue to go higher. I mean, when I'm looking at price action of, let's just talk the S&P, just for argument's sake, the pullbacks are very shallow, and the more shallow those pullbacks are, it's giving less opportunity for fresh shorts to enter. And when they enter, they're immediately stopped out or they have to buy back. Then you've got that mix of FOMO where you have institutional clients that just they need in because they have to participate to keep up with the market. And those pullbacks keep getting shallower and shallower, which is scary because that I feel, and also some of the other principles at Forex Analytix feel we might be on the cusp of some sort of accelerated, I don't want to call it a blow off top, but it really, in essence could be, because we're like, I was trying to make the argument today with our traders. Like, if I owned equities on an institutional level, near these levels, or maybe at 4,000 or maybe whatever, what did I hear yesterday from the FOMC that really says that I should be exiting those positions right now? Nothing. But you've got amazing earnings. Yeah.
I know earnings are backward looking, it's by the quarter, but the guidance has been all right. I mean, the number of companies beating, well over 80%, and the magnitude of the beats for companies that have been about 24%. Generally, we see companies beating expectations. The street's always quite low ball on, in terms of their estimates, but this is way higher. I mean, we're talking standard deviations and on revenues as well. These are fantastic earnings. You hit it with, the Democrats front loading. I think they're front loading this fiscal stimulus because they want to buy votes going into the midterms.
Sure.
Which is not a political view. I just think that they're trying to throw as much stimulus. They know that historically, a new party coming in tends to do quite poorly in the midterms, and I think they want to really go after that and chuck as much stimulus to arrest that. I don't live in America, so I'm not taking a political view, but I think they're trying to front load the stimulus as much as they can. And I think the markets know that. And then, of course, you've got a Fed that just wants to allow the economy to run red hot. They know that unemployment's still way, way too high. And they just want to, they're willing to overlook inflation at the moment, what the market's pricing. Remember, the market's here, the Fed are here. That needs to reconcile itself, and there'll probably be volatility as a result. But those three factors, better earnings, a Fed that wants to allow the economy to be red hot and not listening to the markets, they're not looking at inflation, they're just hell-bent on getting that unemployment rate down. And then you've got that fiscal stimulus. I mean, why would you be short in that environment right now? And then you've got the technicals, like you say, it's just going up and it's going up. The time to short now is not in the mix. It may come, but as I say, I want to see real, inflation expectations moving up. I probably want to see real yields moving up, and I want to see, the market starting to really accelerate those interest rate hikes. That's the time when we'll see the tape become a little bit more messy. The bid dry up. We'll probably go into a distribution in the S&P, and that's when you're going to start seeing better opportunities. Obviously, we watch the VIX because that will be a good indication of whether people are seeing greater propensity for movements and, better hedging flows playing through. At the moment, it's 17.6. We probably want to see that, pushing above 20%. But at the moment, with those three factors, and the fact is that we're all-time highs. Most people don't like buying at all-time highs, but there's no reason in this price action right now to be short. You're either out the market or you're long, but you probably wouldn't want to be short. That time, as I say, I've got the checklist of factors that I'm looking for. Widening of interest rate spreads, high real yields, and really, if implied volatility in the VIX starts pushing above 20% and nicely into 25%, I reckon the bid will dry up in the market, and that's when you're going to get those quick moves down just through order book dynamics. But we're not there yet. It will happen, though, in my mind, and as I say, it'll probably come into that period. Let's see what happens with this, this payrolls number. If it's a blockbuster, we could start seeing those interest rate markets starting to price in. But we will be looking at that Fed meeting in June, and then really, everyone should get an understanding of this, of Jackson Hole Symposium, because it's something that we're going to be talking about time and time and time and time again, and we're going to be thoroughly sick and tired of hearing it by the time, that Jerome Powell comes to talk about, tapering the bond purchases of that meeting.
Well, guys and gals, you heard it here first from Chris. So if you're sick of it in about 2 months' time, you heard it here first, and that's all I have to say about that. So Chris, listen, I want to thank you for your time. But before we go, I just want to let everybody that's listening know that Chris Weston and I have a great working relationship. And if you want to learn how to get more information from Chris and some of his research reports, if you open a Pepperstone account through Forex Analytix, you can find it on our Forex Analytix sponsored page right on our website. If you open an account through that link, you get Forex Analytix for free for several months. You become a premium client of Pepperstone, and then you get to hear, probably enough of Chris where you might actually get sick of him more than these
dulcet tones of the Englishman stroke Australian over here. So yeah.
No, Chris, it's always great to meet with you, and I hope that you guys and gals at home, you open your Pepperstone accounts, be part of the Forex Analytix family and Pepperstone. And then you can hear more of each of us and our ideas and our thought process on how we're going to tackle these markets moving forward. So, Chris Weston, thank you so much for your time.
Good on you, Blake. Thanks, mate. And good. Thanks for all the subscribers. And obviously, I hope you're all safe and well over in the States and wherever you are.
Hey, I'm getting my vaccine next week. I'm pretty excited about that. Finally.
How about you? I'm not too worried about that. Yeah, I think they've been pretty slow over here, to be honest, Blake. But I'm a model human being. Obviously, I think it's I'm in that low risk category. I think they're rolling out to the old people first, and then they'll sort of slow it down. So
yeah, well, Chris, it would be nice when we can return back to life as we know it, or as we had known it in the past. And I hope everybody in the meantime stays safe.
Absolutely.
And once again, thanks for your time, Chris. We'll be talking to you really soon.
Good night, mate.